All right, let's just jump right in. We've got one company, Circle, and suddenly its stock is in an absolute free fall. The market, it's screaming crisis. But the investment thesis we're digging into today asks a totally different question. What if everyone's got it wrong? What if this is actually a once-in-a-generation buying opportunity? Let's get into it.
So yeah, this is what pure panic looks like on a chart, a 20% haircut in just one day. You can just imagine investors seeing that number and hitting the sell button as fast as they could. But really, what on earth could trigger such a massive, violent reaction for a company that's supposed to be a cornerstone of the new digital economy?
Well, it all boils down to this, a single piece of paper. You heard that right. It was a leaked government document, a draft of some new law, and it sent an absolute shockwave through the entire market. So the big question is, what did it say?
All right, so this document is officially called the Digital Asset Market Clarity Act. And yeah, the market's reaction? Swift. Brutal. But hey, before we can decide if everyone's freaking out for a good reason, we gotta understand what this thing actually does.
And here's the juicy part, Section 404. Let's break it down real simple. It basically makes it illegal for companies like Circle to pay out any of the interest they earn on their huge reserves. So, no more yield, no more rewards for holding their stablecoin. Now, at first glance, that sounds terrible, right? I mean, why would you keep your money somewhere if you can't earn a little something on it? And that right there is the fear that gripped the market.
Okay, but hold on, because this is the exact moment where the thesis we're looking at today takes a complete 180. The argument is that the market has completely misunderstood what this law actually means, that this panic isn't just an overreaction, it's actually hiding what's really going on.
So here you have it, the two stories, side by side. On one hand, the market's fear. Banning yield is a disaster. Users are going to run for the hills and take their money with them. But then you've got the thesis, and it says, nope, you're looking at this all wrong. The government isn't killing a feature. They're wiping out Circle's single biggest cost, and that could set them up for an insane explosion in profits.
And this quote really just hits the nail on the head. The analysis is basically saying there's a huge disconnect here. Wall Street is so fixated on the money they think is going to leave, they're completely missing the bigger picture. Every single dollar that stays with Circle is about to become way, way more profitable.
So you get it? The whole point is seeing how what looks like a knockout punch from regulators might actually be a gift in disguise. So let's pop the hood and see exactly how this changes Circle's entire business model from the ground up.
I mean, just let that number sink in. Over $900 million. That's not their total cost. That's what they paid to one partner, Coinbase, in a single year from these revenue-sharing deals. We're not talking about a rounding error here. This is a massive, colossal expense. And the new law? It doesn't just shrink it, it makes it vanish. Poof, gone.
It really breaks down into three simple steps. First, the old way. Circle makes money on its reserves and shares a slice of that pie with its partners. Step 2, the catalyst. The Clarity Act comes along and just says, nope, you can't share that pie anymore. And boom, step 3, the new model. Circle now legally has to keep 100% of the pie for itself. They don't have a choice.
And this leads to something the analysts are calling the narrow bank effect. Think about a regular bank for a second. What's its biggest cost? It's the interest it has to pay you and me to keep our money there, right? Well, this new law basically drops that cost for Circle to zero. The government has basically, and probably accidentally, turned Circle into this ultra-efficient financial machine.
Okay, but this all sounds great if the money stays. That's the billion-dollar question, isn't it? Who cares if you're making more profit per dollar if all the dollars pack up and leave? Well, the thesis tackles this head-on, arguing that Circle's key users aren't going anywhere thanks to a powerful regulatory mode.
And this is probably what you're thinking right now. You've got competitors like Tether offshore, right? They don't have to follow these US rules. So it seems pretty obvious that everyone's just going to move their money over there to get some yield. Seems logical. Except the data tells a completely different story.
Just look at this chart. We're talking about the world of AI agents talking to other AI agents, a market that's poised to be absolutely massive. And in that world, USDC doesn't just have a lead, it has a stranglehold, 98.6%. This shows you this isn't about people chasing a tiny bit of yield. This is about technology that's deeply, structurally baked into the future.
And this is the reason why. For the really big players, we're talking large institutions, AI systems, yield is way down on the list of priorities. What do they care about? They need to know a transaction is final and can't be reversed. They need to be able to move huge amounts of money without a hitch. And most importantly, they need to know everything is above board and legally compliant. They use USDC because it's a reliable piece of financial machinery, not a piggy bank.
This quote from Bernstein just says it all. If you're managing institutional money, money that has compliance officers and regulators breathing down your neck, it's not even a choice. The safety you get from a fully compliant, US-based asset, it's worth way, way more than chasing a tiny bit of yield from some offshore, unregulated entity. It's a no-brainer.
And all this builds up to this really cool concept, regulatory escape velocity. It's that magic moment when being regulated stops being a pain and starts being your superpower. It becomes a competitive advantage, a huge wall that your unregulated competitors just can't climb over to get to the big, serious institutional money.
All right, so let's recap. The business model is getting a massive upgrade, and it looks like the most important customers are sticking around. So now, let's put it all together and see what this actually looks like as an investment case. Time to talk numbers.
So remember that panic-inducing drop to about $101? What's the potential upside from there? We'll take a look at what some of the big Wall Street analysts are saying. Needham's got a price target of 130, and Bernstein, who's really all in on this idea, is calling for 190. That is some serious, serious upside.
But wait, here's the real kicker. You gotta remember, Circle is a tech company at its core. That means its costs are mostly fixed. The platform they built to handle $80 billion, it could handle $500 billion with barely any extra cost. That's the power of scalability.
So when you combine that incredible scalability with a cost of money that's basically zero, what do you get? It means that for every new dollar that comes into the Circle ecosystem, almost all of it, nearly 100%, goes straight to the bottom line as pure profit. That's just wild.
So let's just do a quick before and after. Before this Clarity Act, Circle had a big cost of capital. After, pretty much zero. Their net interest margin, it's about to double. And that EBITDA margin, which was already a really solid 54%, it's expected to climb a lot higher. We're talking about a fundamental transformation of this company's financials.
And honestly, this might be the single most mind-blowing takeaway from the whole analysis. Think about the irony here. The US government, in trying to add rules and regulate this space, may have completely accidentally handed Circle the keys to becoming one of the most profitable financial companies in history. You just can't make this stuff up.
So that's where we're left. You've got the market, which is pricing in an absolute disaster, and then you have this deep dive analysis which paints a picture of a historic, game-changing opportunity. It's the classic story, right? Fear versus the fundamentals. And from what we've seen, the data seems to be telling a very different story from the stock price. The only question left is, what do you think?